The IMF just cut its growth forecast for India, and for an economy that has been the envy of the developing world, that is worth paying attention to. India has been a rare bright spot in a sluggish global economy. For several years running, it has posted GDP growth rates that outpaced China, the United States, and most other large nations. That record drew serious money from foreign investors and earned India a reputation as the standout economy in Asia. Now, the International Monetary Fund is signaling that even India is not immune to the forces slowing growth around the world. The headwinds are familiar: tighter financial conditions, softer demand for exports, and inflation that has proven harder to shake than policymakers hoped. When those forces combine, even a fast-growing economy starts to lose some of its momentum. The practical consequences of a lower growth forecast are straightforward. Slower GDP growth means fewer jobs created. It means less tax revenue flowing into government coffers. It means corporate earnings come under pressure. For ordinary households, it often shows up as more cautious hiring and slower wage growth, squeezing budgets that are already stretched by elevated prices on everyday goods. That last point puts India's central bank, the Reserve Bank of India, in a difficult position. If growth slows, but prices stay elevated, the RBI faces a classic policy trap. Cutting interest rates would give the economy a boost, but it risks pushing inflation higher. Holding rates steady keeps inflation in check, but it can dampen borrowing and investment at exactly the wrong time. There is no clean answer, and markets will be watching the RBI's next moves closely. Indian equities could feel the pressure as well, particularly in sectors tied to domestic consumption and infrastructure. Foreign investors, who have poured significant capital into Indian stocks and bonds in recent years, may start to reassess if the growth story looks less compelling than it did. Currency moves are also worth monitoring. A softer rupee raises the cost of imports, which feeds back into the inflation problem the RBI is already trying to manage. It is worth keeping some perspective here. Even after the IMF's revision, India is still widely expected to remain one of the fastest-growing large economies in the world. The country's long-term structural advantages, a young population, a rising middle class, and a growing services sector, have not changed. The downgrade is not a crisis call. It is a caution flag. The next RBI rate decision, along with India's upcoming trade and inflation data, will be the clearest tests of whether the economy can hold its footing. Watch those numbers. They will tell you whether the IMF's concern is a blip or the beginning of a broader slowdown. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.